Hi, my name's Andy, and I'm the founder of BDB Wealth. I recently recorded 3 separate videos on what I view as important topics for private equity professionals and how holistic wealth management can really drive outsized results for their financial situation. First, I touched on building a variety of cases for financial planning depending on the timing and amount of carry and bonus and things of that nature. Then I talked about tax loss harvesting and how doing that effectively can reduce your tax bill when you have big investments sell. In the third video, I talked about a variety of trust and estate strategies that private equity professionals should be considering. So I've included the 3 videos here. They're short, quick, and I hope you enjoy. This is video number 1 in a series of videos where I talk about the benefits of holistic wealth management for individuals who work at private equity firms. Now, I know there's a lot of sexy topics out there, moving your carried interest out of your estate, using tax loss harvesting to build up tax losses ahead of your investments being realized to limit your tax impact. And all of those are sexy, but I wanted to start with something a little more fundamental. I want to talk about how individuals in this career path should be thinking about financial planning. There is a lot of variability when you are a late stage private equity employee. A large portion of your income is dependent on your carry, which you do not know the value of it or the timing of it. There's a lot of liquidity issues due to co-invest needs. And your bonus is also dependent on overall performance. And so when you take all of those unknowns and you try to plan for the life that you want to lead, the house you want to buy, the kids' private school, the vacations, the vacation houses, it's really tough. And so before you even think about investing or estate planning, it's essential to build a scenario-based financial plan. And what I like to do is similar to how you model outcomes at a business. I like to use various assumptions and build downside base and upside cases based on your carry and bonus amounts, the carry amount as well as the timing. And then you compare that to the goals you may have. And I like to break goals into 2 tiers. The first being essential goals. So, the house we want to buy to live in on a day-to-day basis, the kids' schools, things that I know I need to achieve. And then dream goals. And these are the things that you want to achieve when things work out. Buy a vacation house, a variety of other things that you may want to achieve in your life. And so then I like to compare those goals to 3 different cases, as I said. One where you get more carry than expected or in earlier timing, or a base case where you get the expected carry at the expected time, or the downside case, which is lower than expected carry and it comes late. And so I like to use those tools and hopefully understand how do we achieve the essential goals even in the downside case, and how do we look at timing and the acceleration of when you can achieve those dream goals in the base and the upside case. Once again, this isn't essential, but it's helpful modeling to help you build the right way to think about your own financial plan and ultimately build comfort in the approach that you're taking from a spending standpoint. Today, I want to talk about something maybe a bit sexier, and that is using tax loss harvesting to reduce your tax bill when investments are sold and carry is realized. The challenge of working in this industry is you don't know when investments are going to be sold and your carry will be realized. What you do know is you will hopefully be paying capital gains tax on those investments when they're sold because of the gain. However, there are ways to minimize that tax bill as much as possible. One of the best ways to do that is to have a taxable brokerage account of liquid securities that you are aggressively harvesting tax losses, which you can then carry forward to offset against the tax gains when you sell the private investments. Tax loss harvesting as a strategy has pros and cons, but for someone who is confident they will have a large taxable gain in the near future is an incredible tool to limit the tax bill on that. Tax loss harvesting is a systematic strategy to aggressively sell losses due to volatility on a stock portfolio while still mimicking the returns of general indices. We could talk for 30 minutes about how it works, but I want to keep it relatively simple for this short video. But in a general case, historical data, someone with $1 million stock portfolio can typically harvest 3 to 7% of that portfolio per year with standard tax loss harvesting and 7 to 15% with levered long short tax loss harvesting. So if you think about that $1 million portfolio, let's assume it's 5% and 10%. You can harvest $50,000 or $100,000 of losses that you can then carry forward to eventually offset your capital gain when you sell your private investments. And that is on an annual basis. So if you do that for 5 years, you can really start to build a cushion to help reduce your tax bill. And even if you have $1 million taxable brokerage account, you can pretty quickly save 6 figures in taxes when the private investments are sold. This is a great tool for private equity professionals because it helps them limit their tax bill eventually when the private investments are sold. This is a very nuanced topic, so I'll stop here. But if you have any questions or interested in learning more about this, feel free to reach out. In this video, I'm going to talk a little bit about estate and gift optimization. When I think about estate planning, there are 2 things that need to happen. The first is your family prepared for any unexpected death? So to me, this is more of the core logistics, ensuring that they're airtight. So your wills, your revocable trust, your power of attorney, and things like that. That is important regardless of your net worth. Then there's the second bucket, which is really important for individuals that are high net worth and above any federal or state exemption limits. Right now, the federal exemption limit is $15 million per person or $30 million per couple. But many states have exemption limits lower than that, New York included. And so there's a lot that can happen when you may only have a net worth of 7 or 15 million that may impact taxes for the next generation if anything were to happen. And so for individuals who may not have that net worth yet, but are going to be there with carry payouts, there's a lot you should be doing now to prepare and optimize for that future state. And what I find important here is it's essential to partner with the right PE-aware estate planning attorneys. These laws are changing fast, and these high-tax states are doing everything they can to limit the ability of individuals to move things out of the state. But one major benefit that private equity investors have is these large assets and payouts that come from carry, that starts as a relatively low-value asset. And so when you move that asset out of your estate, it takes a relatively small amount of your exemption relative to the future payout, which will grow out of your estate. And so for private equity individuals, there's a lot of strategies and a lot you can be doing to limit your overall taxes as you think about next generation. So if you want to learn more or talk about how estate planning can benefit you as you think through the next 10 years of your life, I'd be happy to have a conversation as we talk about how this is just one part of your holistic wealth strategy.